Yeah, so we got a good one today. Got a lot of feedback, a lot of positive feedback from the streams in the last 2 weeks. I think you know there was a lot of aha moments from many of our traders. So brilliant. Keep that feedback coming in. Much appreciated. Um, and as usual, there are objectives. Do feel free, guys. Those Q&As. If you have got any questions, there's no such thing as a stupid question. If you've got an interesting chart you want to share, feel free to email me. All right. Don't forget that as much as I'm the one sort of teaching you a principle today, it doesn't mean I can't learn anything from you guys. So do feel free to send me something interesting. You've got my email towards the end of the stream. Okay. We're going to continue with this concept of failed break of support and resistance. So we're gonna revisit things, okay? And I want to do this for a very purposeful reason. I want to drive home, this discussion that we had over the last 2 weeks. Really, just show you how these things are playing out, not to float my own boat, okay? It's got bugger all to do with, whether or not I've been right and wrong. I actually had a trader reach out this week and say, excellent call on the gold, and what's your view on this? Okay, it's not about being right in this job. For me, the concept of failed break and support and resistance, the most crucial aspect of it is that it just puts you on the right side of the market. Okay, and that's the purpose of all the streams we do is for me to engage with you and make sure I'm helping you to get on the right side of the market. Okay. So we're going to continue along the lines of that failed break and support, just revisit some of those charts, the implications in particular this week going forward. Okay, so this is where we're going to start. Failed support and resistance revisited. For those of you that are just tuning into the stream and you haven't joined us for the last 2 weeks, in essence what we looked at, okay, we looked at the pound versus the dollar, we looked at the gold, and we looked at the oil, and all we did was did a just a basic technical analysis, which is when markets get stuck in these big time frame ranges. Now, big time frame, I don't mean a couple of hours. Okay, obviously, this concept can be applied to a couple of hours, but in general, if you're trading sort of more swing, more macro, bigger time frame, bigger trade opportunity, or longer term time frame opportunities. Ultimately, this is a concept you've got to understand. Okay, when a market gets into a sideways range, ultimately it's likely to stay there for a lot longer than what you think. And when I say that, some of the markets that come to mind is go look at the Japanese yen. Okay, now what I would say is you do find certain markets, can stay stuck in ranges for years sometimes. And, if you sort of very hell-bent on thinking every time we get to, sort of the resistance areas that, we're going to break out and you want to be long for it, or, looking for breakdowns when we get to support, well, you're going to end up sort of, as they say, the expression, a lot of paper cuts. And they can be particularly painful, but if you just very switched on, and we spoke last week, I gave you the the real key differentiation between determining what is first and foremost a breakout trade. We look for the three signals. Okay, when we've got those three signals, we look for the breakout and continuation. We also said if we don't see those three signals, okay, if we don't see the confirmed closes, if we don't see the potential low volume area and the trending move, if we don't see those strong closes, if we don't get all three of those, the red lights should be going off. Okay, the real alarm bells should be ringing in our heads, and the probability, or the potential for a market to just re-enter that range and trade back in that range, the probability of that goes through the roof. Okay, so let's revisit this, and to do this we're just going to go through the charts. I've just got some daily charts, and I just want to show them to you. So the first one is the pound. Let's just get that up quickly. Okay, so we're going to have a look here, and what we're looking at is the pound. Okay, these are obviously daily charts, and we spoke about this range. Okay, very simple range between 122 the figure and 126.80, and we said this 126.80 was key resistance. Okay, it had sort of defined itself in April as resistance, again at the beginning of May. Twice we got very strong offers off of it. We then got that that move above the 126.80. And on this day, okay, it's very good. We can actually look at this example. If we go back to the 5th of June, we can really see how, as we came into that 200-day moving average, we can see that there was quite a weak close there. Okay, the market didn't show strength breaking through that resistance, which that was the first sort of alarm bell. Okay, we should have seen strength, through that breakthrough. The next day, obviously, the market came. It tested that previous resistance. Okay, that's very unusual. It's very unusual for a market that's breaking out of a key resistance to come back and give you such an easy fill. Okay, and we can see, in hindsight, I know these things are always easy in hindsight. Okay. But we could see how the market really failed. It struggled above that 126.80. Yes, we got all the way up to 28.5. So we got a good, sort of 150 pips above that resistance. But ultimately, okay, the market has now not just come back into that range, but it's actually now starting to offer quite aggressively towards the other side of the range. Okay, so again, take the lesson from it. This is not about a right and wrong. This is just about you learning to interpret, what type of, nature or context the market is in. Okay, that being said, pound now is going to come and, let me rephrase that, sorry. Pound, there's a high probability that we're going to come test that support now at 122. Okay, so why I like to revisit this is, generally speaking, when a market is in a sideways range, okay, we're in a very strong structured range, the path of released resistance becomes a very important concept to understand. Okay, there is no point in trying to bid this market at current price. Okay, let it come down to 122 figure. If the price action's there, we want to look to be a buyer of the market and then look to continue playing in this range. Now, one of the things I got asked this week was, what was one of the indications that someone could use to determine when markets are actually trading in a sideways range? And it's a fantastic question. Now, I'll say there's probably the single most beneficial use of a moving average is that exactly. Okay, when your moving averages start to flatten. Okay, as you can see, the 200-day moving average, when they start to flatten like this, that's a really good indication of a market that's moving sideways. Okay, because in essence what it's saying is that the average price over, say, 100 days, okay, is not moved. Okay, so think about that for a second. If the average price over the last 100 days is exactly the same, in other words, it's in a really tight range, what that's telling you is the market's inability to trend one direction or the other. Okay, so that's where a moving average comes in handy, and it's not so much the anything other than the steepness. Okay, so what you want to see is if you've got a really steep moving average, okay, obviously that's telling you there's quite a lot of strong price direction to the upside, whereas if you've got a flat 100-day moving average, that's telling you prices been going nowhere. Okay, and the probability for it to continue going nowhere is extremely high. Okay, and that's crucial to point out, because so many traders want to, they want to almost, in their heads, we want the market to move. That's our job. We want the market to go up, so we desperately want to be a buyer of it. But if a market's going sideways, okay, remember what I said in the beginning. Go look at markets like the Japanese yen and look how long they can stay in these ranges for. Okay, make yourself aware of that, because when a market enters these, really strong structured ranges, unless you're willing to play within that range, okay, you are going to cut yourself paper cuts. Okay, so keep an eye on this pound, 122.05s. We should test that pretty early on in the week. And yeah, by all means, look for the longs there. Okay, we're probably going to discuss this next week. See how it tested that 122.05. Should be a really good buy side opportunity first up. Okay, remember, if we start to see the market break down, okay, if we get below that 122.05 and we see the three signals, i.e. price confirmation on the close, i.e. strong price action through that level, in other words, real sell side action through there, no two-way trade, and then three, that sort of real momentum type, volatility, by all means, then go with the break, okay, because then potentially we have broken this range and we could start to offer a little bit lower. But until we see those three signals, don't try to reinvent the wheel. Don't try and, preempt a market breaking out. Okay, it's a very, very strong range. This, we've been in it for 3 months. We could very well still be here in 3 months' time. Okay, that was the first one. Let's look at gold. Okay, and this is a favorite of mine, is the gold, because again, a very strong structure, and we've been here since April in this, sort of 1660 up to 1780 price range. Okay, and again, someone said to me, yeah, great call on the gold. It wasn't a great call on the gold. Okay, I can guarantee you, I haven't been long gold for the last, $60, $70. Yes, okay, I made something on the up move, right? But in essence, gold should move all the way back up to the 1780 area before then we start to see sellers come back in. Okay, very strongly defined range. We can see it there. Markets get sold very aggressively off the top. Note the tails get bought very aggressively off the bottom. Okay, again a second tail, and again a second tail. So we can see very strong support off of the lows, very strong resistance off of the highs. Okay, don't be surprised if gold does gap up on Sunday night. Okay, very possible this is done on a Sunday, the stream. So if the gold does gap up to that 1780, don't be afraid to sell it there. Okay, should offer you a very good trade opportunity, over the course of the week. Okay, and then obviously the last one was the, what was it? Let's have a quick look. Oil. Okay, let's have a look at oil. And to do that, I'm just going to get up a cash chart. Just bear with me for 1 second. And where's that oil market? Okay. Okay, so sorry, I just had to get this off the Reuters quickly. And what you're looking at here is the spot oil. Okay, and we've been talking about this oil, talking about the strong range it was in. Okay, and now I'm just going to zoom that out a bit so you can see that range. Okay, so there's our range. We could see, from 2016 already, 40s to 42s has been a massive support area. It's held once, twice, 3 times, 4 times, 5 times, 6 times. It's been key support. Okay, we haven't tested it yet. Very likely to test this first thing at the start of the week, anywhere between $41 and $42 a barrel on the spot. By just, you've got to be a seller there. First time testers, you've got to be a seller. Oil should be offering you a good $10 move on that. So really good swing position opportunity. Okay, keep that in the back of your mind, because when these big structures are in play, if you're not aware of them, okay, if you are not aware of the big time frame structure, all you're going to be doing is you're going to be positioning yourself in some really difficult spots. Okay, and the result of that is you're just not going to be finding yourself with easy trade opportunities. Okay, so it's not a case of us day traders just go, oh cool, we're going to sell 41 and we sit on it for $10, with full size. It doesn't work like that. Okay, we also have emotions, we also have psychology at play, we also have risk at play. Okay, but it's about knowing that the resistance there at 41, once it tests and it fails, we're only looking to be sellers. Okay, we come in every day, we put that, you almost got to think of it as we put on the sell side cap. Okay, we put on our caps that say, okay, we only want to be a seller because we failed at this resistance, and we're looking for little strategic opportunities to sell the market. Okay, whether that's little trend days, or whether that's selling into weak bids, whatever it might be. Okay, we're looking for those opportunities to be short the market. Okay, so those are our three little failed support and resistance, that we've revisited. Okay, the one was the gold. It failed to break down below that support and got bought back up. The other one was the pound, failed above that resistance, got sold back down, and now we want to see how that oil responds. Okay, we want to see what it does at that 41, 42 this week, and hopefully, one of the best catchphrases old Mike Bellafor ever came up with was one good trade. Okay, you only need to execute one good trade. Imagine you come into this oil, you sell it at 41 with a stop at 43, and you ride it for $5-6. Okay, on a one lot, that's $6,000. Okay, it's a one lot trade with really good risk reward metrics, and really playing with the probabilities on your side, and that's ultimately what you're looking to try and do. Okay, so today's principle, price action. Okay, I hear this word thrown around very loosely, and I don't think too many people have got a real understanding of what price action is. Okay, price action isn't just It isn't just the ladder going up or down, or the price going from 1 to 10 and 10 to 1. That's not price action. Okay, price action is, if I was to put it in an English dictionary, okay, price action is the market's ability to move as various pieces of information come into it. Okay, so as we're receiving whatever it might be, economic data, central bank meetings, virus updates, trend day in the bond markets. So as we're receiving these tidbits of information from the market, how is price responding? Okay, that is price action. It's how the price is responding based on elements of information. Okay, now the first question I've posed is this question of how should it move? Okay, how did it move? And what we're trying to say here is ultimately, okay, with all the pieces of information we get in the market, right, we should have an expectation of how it moved. For example, right, on Friday afternoon, Apple came out with an announcement that they're going to close 6 of their stores, I think 4 in Florida, 2 in Arizona, something along the lines of that, okay, due to the coronavirus. So my question is, how should it have moved? How should the Apple stock have traded? Okay, and you should all be able to answer that. You should all have just a basic understanding of how price should have moved, the expected move, right? Because as traders, right, we develop this understanding of how price should move. But then our job is to be objective and actually go and physically see how did it move? What was the price action actually like? Okay, because it's that price action that's giving us all the information we need to know about the market. Okay, for example, we know Apple has rebounded from its lows and it's currently sitting at record highs. Okay, now given that the market's technical landscape is very long, there's a lot of longs in the market, probably a lot of weak longs as well, chasing the move, therefore the probability of a profit-taking move is quite high. Okay, now because we know that, the expectation is that we probably should have seen quite a bit of selling come into market. Why? Just a bit of profit-taking. Okay, not necessarily that this is stock moving news, okay, but it should just prompt a little bit of profit-taking. So the question is, how did it move? All right. Now, what we're going to do is we're going to pose this question over the ECB, the Bank of England, and the Fed. We've just had a meeting from each of them this month, okay, and I'm going to pose that question to you. How should it have moved based on the information, and how did it move? And you will see why price action is so crucial in decision making. All right. So the first one, ECB. Okay, so ECB came out. Expectation was for a 500 billion package, an increase in QE. Okay, so an increase in their quantitative easing. And ultimately, they delivered 600 billion. So the question is, how should it have moved? How should the euro against the dollar have moved? Right? Now, a lot of traders would have said instinctively, well, it's more QE, therefore interest rates are likely to stay lower for longer. Why? Because the ECB has already said that they will only raise interest rates once they're done with QE. Okay? That's a fairly logical, fundamental argument. What did the price do? Let's have a look. Okay, so what we're looking at is this day here. And as you can see, in this entire trend up, all right, we actually had the largest up day. All right, we then had a day of profit taking before we continued higher. In other words, an increased package, a more QE than expected, was actually net positive for the equity markets. Now, what was most fascinating is if you're trading the bonds, you would have expected bonds to rally. Why? Because the ECB is telling you they're going to buy more bonds than expected. What did bonds do? They actually sold off. Okay. Now this is crucial because the information you've just received there is that the market interpreted more quantitative easing as actually having the potential to be reflationary. In other words, longer dated bonds sold off. Yields went up. So the market saw this as a potential positive. Hence the euro rallied. Okay. Next one, Bank of England. All right, they came out this past week, and they said to us they're only going to do QE of 100 billion. Okay, the market was expecting them to do 100 billion. They did 100 billion, so they delivered what was expected. Okay, what did the pound do? Now, a lot of you might say, well, it probably should have traded unchanged. Okay, if you read my Twitter just before the announcement, I said I leaned on the fact that if the Bank of England, does more than expected, you should see the pound rally. Why? Similar to what the ECB did. All right. It prompts the potential for, inflation. Right? Ultimately what happened is initially the gilt sold off and the pound went bid, but then they both reversed course. Okay, in other words, the market told us, as we can see on this day here, okay, the market actually told us they were very unhappy that the Bank of England hadn't done more. In other words, they're saying to the Bank of England, you've not done enough. Okay, so straight away, what information do we take away from this? Well, we take away the information that we're entering a regime now where unless the central banks deliver more, the market's reactions are quite negative. Okay, now ask yourself, why would the markets be reacting negatively to central banks delivering as expected? Okay, possibly because the markets understand that there's a lot of fragilities out there. Unless central banks are willing to over-deliver, right, they're not going to be able to sustain this euphoria that we've seen over the last 2 months. Okay, last one. The Fed came out early June, right, and they pretty much delivered exactly as expected. Okay, they came out and they told us ultimately that yes, things are not looking so great, but they told us they're not going to be tapering their daily purchases below 80 billion. In other words, they're still buying 80 billion of bonds a month. Okay, it was a lot more than was expected, so they were almost more dovish than expected. Right? What did the equities do? Okay, this was this day, yeah, and they actually sold off. What does that tell us in terms of information? Well, if a central bank was more dovish than expected and the price went down, it's telling us that there's actually some profit taking coming into the market. In other words, the market was expecting, all right, they were expecting the positive message and it wasn't dovish enough. All right, what do we have the next day? Okay, a really large sell-off day, a lot of profit taking coming into the market. So this is crucial, guys. Price action is about what should the market have done based on the information. What did it do? Okay, the what did it do tells you about what comes next. Okay, and that's crucial. All right, now the next bit of concept you've got to understand is this concept of strength and weakness. Okay, what do we mean by strength and weakness? All right, I'm going to show you 2 examples of this, but ultimately price action, okay, whether it's strong or whether it's weak, ultimately determines what comes next. Okay, now the first example I want to use is Apple. Okay, simply because we had this out on Friday, news came out. Okay, and the news was they're closing a couple of stores. Now, you would expect, if this is now Apple's sort of almost a policy and procedure, if they're going to close stores because Florida and Arizona are seeing spikes, all right, it's not going to be too far along now until Apple closes stores, not just in other states in the US, but potentially other countries around the world. Okay, we're seeing infection rates go up in Germany. Are they going to close stores there next? What about London? What about some of the Asian countries? Okay, so the information was relatively sort of concerning for Apple stock. But what did Apple stock do? Okay, it sold off very aggressively. Okay, we had a very, very decent move. We traded $10, $12 range on the day, but we sold off $10 on the move. But then look what it did. Look how it closed. Okay, this is what we call a strong close. So what you have to ask yourself is, should we have seen strength in the close based on the information? In other words, should the price action have been that strong based on the information? Okay, the simple answer is no. Right? Now, it's not to say that Apple won't continue to drift down, but it is telling you that there are very strong buyers in this market. Okay, how about the S&P 500? Right, so we can see, again, over the course of this week, right, this past week predominantly, the markets were fixated on this concept of second waves. Okay, and the entire week, all we saw was infection rates in Texas and Florida is going through the roof. Okay, that was the theme, the narrative for the week, which was the second wave. The second wave is coming. Right? What would we have expected the week to do? Would we have expected strength or weakness on the week? Well, ultimately, we opened on the low of the week, we rallied, and we closed pretty much towards the top, top quarter of the week. Okay, so ask yourself, in terms of price action, is this what we would expect based on all the information flow? The simple answer is no. Okay, if the second infection rate was important to the market, we wouldn't be closing strong like this. Right? If anything, we'd be closing very weak on the week. I'm not saying sell off 10%, but what I'm saying is the close on the week should be quite weak. And if anything, it was actually quite a semi-strong close on the week. And that's what price action is. It gives us that underlying information of what price is doing. Price is not going down when it should be going down. Okay. Now, where we want to go from this is I want to quickly take you to a tip of mine, which I love doing. On a weekly basis, when I'm doing my analysis, okay, I always go through a weekly chart, and I'll show you why. Okay. Given the narrative, and this is a nice little exercise for you to try. Given the narratives, first thing you do, take a piece of paper, write down over the course of the week, what were the key narratives? Okay, so this past week, like I said, it was all about the infection rates in the US spiking. That's pretty much what's driven markets this week. Yes, okay, we can say that, China and India had a little spat and they, shot a few soldiers, and we can say that North Korea blew up a building and all that. But what are the real sort of market-moving type of narratives that came across this week? Right? And ultimately, we would have thought that this week would have been a little bit of a risk-off type week. Okay, we would have seen money move back into the bonds, maybe equity see a little bit of profit taking. So let's look at it. Okay, what did the bunds do on the week? Weekly bunds closed flat, unchanged. Okay, let's go to the gold. What did the gold do on the week? Okay, gold closed about $20 higher. Okay, so that makes sense. Makes sense. Bunds a little bit concerned, obviously. Closed unchanged on the week. Gold a little bit higher on the week. Okay, what do we think the equities did? Right, we can see the ES 500. Well, the ES 500 actually closed up on the week. Right, yes, we had a large selling tail that came predominantly on Friday. Okay, but we still closed up on the week even with a negative narrative. What about Europe? Okay, same thing in Europe. Right, what about the currencies? Right, how's the dollar been performing in a risk-off environment? Well, typically this year, whenever there's risk-off, the dollar rallies. Okay, whenever there's risk-on, the dollar sells off. What did the dollar do this week? Let's look at the euro. Okay, yeah, we can see the euro's down on the week. What about the pound? Okay, pound's a little bit more sensitive to risk-off. What did the pound do? Okay, quite strongly lower. Okay, and that's how we start to build an understanding of what price action's doing. Okay, based on what I've just shown you, those four charts. Right, the price action this week pretty much confirms the narrative. Okay, we should have seen a little bit of a risk-off tone coming into the market with this concern of secondary waves. Okay, start working on that price action. Start working on these interpretations. This is one way to do it with just a little game that I like to play on a week-to-week basis. Okay, now I wanted to get to volatility, and this is where we're going to kind of finish today, because it's very, very important that you guys learn to start using the VIX as part of your trading. Okay, and I'm going to show you why. All right, what you're looking at is a VIX daily. And what you can see, okay, this is the FOMC day. Okay, and this is the day after FOMC. So you can see now that the VIX for the last 2.5 months has been stuck in this range between 25 and 44. Now, it's no surprise, okay, we're talking about ranges, we're talking about support and resistance. The VIX is no different, okay, but we are now in an elevated range of the VIX between 25 and 45. Right? Whenever we start to see the VIX rise, we start to see the equities come off. Okay, this is the S&P 500. Whenever we see the VIX start to fall, as we saw from Monday, okay, what do we see in the S&P? It starts to bid. Okay, so I was asked a question this week: where do I think equities are going? I think that's the wrong question. Okay, the answer is, where do you think the VIX is going? Okay, if you have an understanding of where the VIX is going, you'll have an understanding then where the equities are going. Right? So long as these equities stay, or so long as this VIX stays in this range between 25 and 45, I would suggest to expect volatility. So keep expecting the potential for a 2-3% move in the markets. Okay, not just the DAX and the Eurostoxx, S&P, all equity markets. Okay, but until we can break above 45, equities are not going to meaningfully offer. Equally, before we break below 25, okay, equities are not going to meaningfully bid. Right, so straight away a light bulb should be going on your head. Wow, well, if VIX is in a big range, support and resistance, then it's very possible that the equities now find a big range as well. Yeah? Where's the support? Well, we can see that support came in at 2,900. Where's the resistance? 3,200. Okay? Don't be surprised as we revisit this over the next couple of weeks if we stay inside this range between 2,900 and 3,200. Not because Brannigan says so, but because the VIX is telling us that the potential there is for it. Okay? Keep an eye on that. And it's important. Remember, the sooner you can understand these ranges and establish these ranges, the sooner you can actually profit from them quite handsomely. Okay, because you'll be buying in the right areas, because you'll be selling in the right areas. All right, guys, that's a wrap for this week. As usual, there's my email address. Do feel free to oh, sorry guys, I just realized I wasn't even showing you the chart of the VIX. Apologies, I'm going to get that VIX up. Okay, so there's the VIX that we're talking about. Take a snapshot of it. Have a look at that. That was the range I was talking about, 25 to 45. Okay, and this is the S&P chart. Okay, between the 2900 and the 3200. All right, so VIX again, that's our range. As long as we stay in that range, we should then see the S&P 500, Nasdaq, Russell, Dow all stay within their ranges.